Karma Limited got incorporated in 1980s as a private limited company and started its business into two segments, printing and construction. The two business activities were completely different, but those were managed very well, and the company grew significantly over a period of time. In the year 2001, the company got converted into a public company. In 2008, the company also got listed in Bombay Stock Exchange. The turnover of the company went on increasing, however, the margins were not increasing as per the expectations of the management. The management analyzed this aspect and realized that the margins were not so high in case of the printing segment. So the company decided to focus more on the construction business and included infrastructure in its line of business. This was also because of the fact that the government policies were favorable towards the infrastructure sector. Eventually, the company decided to sell its printing segment in 2020. The new investor, that is buyer for the printing segment, carried out a due diligence of the printing business involving various aspects, and the company sold this segment in Jan 2021. See, basically, what happens is that when you talk about due diligence means when any investor is investing in the company, is it worth investing? Is it viable? So, in case of corporate restructuring, it's a type of business investigation where we look into overvalued assets and hidden liabilities. So, whether a particular investment is it feasible at a particular price or not, that's what we check into due diligence. Since the business of the company included infrastructure, it involved transactions with the government officials also. The management suspected certain suspicious transactions for which it decided to carry out forensic accounting in the financial year 21-22. During the audit, certain transactions were identified highly risky, on which management discussed and set up certain new processes, stringent controls so that the business can function in an efficient manner. Now, what has happened is that the company has included infrastructure business. So there are certain transactions. So what they did is that they have carrying out forensic accounting. See, forensic accounting basically what happens is that it's a mixture of investigation, audit, accounting to arrive that whether any fraud exists. That's the whole idea of forensic accounting. For the financial year 31st March 24, due diligence was done for the company, which impacted the company significantly in terms of reputation and business. Company lost most significant contracts during the process of investigation itself. At the time of due diligence review, reviewer assessed that the business feasibility also to assess whether the current business would be more beneficial in future or not. The management of Karma Limited did not understand this perspective, so management argued that the reviewer has no power to assess the business feasibility as the company was running a profitable business for many years. The company had various litigation going on, including those related to matter of taxation. Company had taken consultation in respect of those litigation from professionals and renowned legal tax consultant. The reviewer of due diligence reviewed these consultations documents and also asked for documents related to these matters. Further, he also suggested that the decision taken by the company in some matters was not correct. At the time of investigation, the reviewer asked about the background of the promoters of the company. The management explained that there was no need for this investigation. Definitely, in due diligence, we ask for background, we look into the litigations against the company. Again, as I highlighted you that the integrity of the promoter matters a lot, and also is there any litigation against the company? Even that also to be checked. Further, management explained that the company has already gone through the processes of due diligence, forensic accounting in the previous years. There was no doubt raised on the promoters of the company. So the background of promoters cannot be shared with the reviewer. I think this is not acceptable according to me. They have all the rights to check the background of the promoter because promoter are the decision makers. Promoters integrity has an impact on the business as well. Anyway, let us see the MCQ question. The management argued that the reviewer has no power to assess the business feasibility. Business feasibility means whether the business will be profitable or not, as the company has been running profitable business for many years. Which of the following statement should be correct? The contention of the management was correct. Absolutely no. No. Reviewer can always assess the business feasibility. So A is absolutely wrong. B, reviewer was correct as due diligence covers assessment of business visibility as well. Yes, B is the answer, but let us see C and D as well. Reviewer was correct as due diligence covers assessment of business visibility as well. However, the company was doing this business for decades. It should not have been carried out by the reviewer. No, no, no. So C is definitely not correct. So reviewer can always assess the business visibility. Management was correct. Stop here only. No way management is correct. That's the thing here. So in such case, actually, here the reviewer is correct. Now the pendulum goes between B and C. So in the B, it's said that that reviewer was correct as due diligence assessment of business covers assessment of business assessment feasibility as well. Whereas C says that reviewer was correct as due diligence covers the assessment of business feasibility as well. However, the company was doing this business decade, so it should have not been carried out by the reviewer. No. C is also ruled out, so B will be the right answer. Next one. The due diligence reviewer was given an audited financial statement of the company for his financial review for the year ended March 24. However, reviewer asked for financial statement for the year ended 31st March 23, which was already audited by statutory auditors of the company, and the management of the company declined this request. Management is correct. No, sir, you have to share the details. You need to share the details. That's the thing here. Second option B, reviewer can ask for documents even for the period for which audit is completed. Yes, he can always ask for the document. B sounds to be sensible. C, let us see. Reviewer can ask for financial statement for the period for which audit is completed, but he cannot give any statement on them. He can collect the same for his documentation purpose only as per the requirement of the auditing standards actually. Okay. So here in this case actually here so and last one, the reviewer has no right to review the financial statement of the period other than the period under the review. So here no re- management is correct and reviewer has no right to review the financial statement of the period other than the period under review. So A and D are completely ruled out. The ball pendulum is between B and C. B and C. That's the thing here. Okay, so it is going between the B and C. Okay, so B, what it says, reviewer can ask for documents even for the period for which audit is completed, and C says that reviewer can ask for financial statement for the period for which audit is completed. He cannot give any statement on them. He can collect as a part of documentation. No, C is restrictive. So rather B is a right answer. B is definitely a right answer. So for ninth one, it is B. Next one, the reviewer for due diligence reviewed consultation documents pertaining to various litigation going on, including those related to matter of taxation. Also asked for the documents relating to these matters. Further, he also suggested that the decision taken by the company in some matters was not correct. Now, A, reviewer needs to have independent assessment of legal tax cases and any outcome needs to be discussed with the management. A seems to be very sensible, but let us see B. The company should not have provided documents as they are confidential, ruled out. B is completely ruled out. The company should provide the details. That's a part of diligence review because we want to find out is there any hidden liability. C, the reviewer can study the tax consultation document but cannot give his opinion as the company already took the opinion from professional consultant. So this is again restrictive. Reviewer can always have his own interpretation and opinion. C is also ruled out. Tax and legal matters are not part of due diligence exercise. No, sir, because you may come across any kind of hidden liability. So now the answer pendulum moves to A. For 10th one, A is the right answer. That is reviewer needs to have an independent assessment of the legal and tax cases and any outcome needs to be discussed with the management. Next one, the last question on this. The management may refuse to share the details of promoters. They cannot do it. They need to share the details. Since the company has already went through due diligence of forensic accounting the previous year, management may refuse to provide promoter details to the reviewer. Ruled out. No. A cannot be the answer. Let us see the B. As background of promoters has no bearing on the financials of the company, reviewer should not ask for details of promoter and management may refuse to provide the same. No, promoter's background is must actually here. What is the background of promoter? You need to is a promoter? What is his integrity level? So B is also ruled out. Since company went through process of forensic accounting in the past, set up new processes, internal controls, reviewer should not investigate background of promoters. No, sir, this is also not acceptable. Point number D, contention of management is not correct. Yes, management is not correct. I was telling you that they can always take the background of the promoter. The contention of the management is not correct. So D is the right option. Okay.